So the first step listeners have to take in mind, is my land entitled, approved? Does it have permits? You might be able to just get a construction loan depending on how much money you're bringing to the deal. But are you subdividing? Are you actually developing dirt? You're going to need private capital or A&D capital.
Welcome to the Build to Rent podcast, the first ever real estate show dedicated exclusively to helping investors go from raw dirt to a cash flowing rental property. Whether you're looking to do a massive syndication or a one-off rental property, the Build to Rent podcast will help you get there. Our hosts, Steve Olson, Chase Levitt, and Sherida Zanger, bring together more than 4,000 properties of experience as they break down how to find and finance projects, make the most of market and tax strategies, and maximize the returns of a build-to-rent portfolio. This is the Build to Rent podcast. And now, today's episode.
Welcome to the Build for Rent podcast. Steve Olson here along with Chase Levitt and Sherida Zanger. We've got a good topic for you today about financing. So financing in the Build for Rent space is, it's kind of the Wild West, right? We were at a convention a couple of weeks ago in Vegas dedicated exclusively to Build for Rent. I went to that same convention, I think it was in 2013 or 2014. I think we were lucky to have 100 people there, and it was a very kind of unknown space. And all the financing that was available was, we'll loan you money. We got capital, 5 points, 17% interest, right? 50% loan to value. It was terrible money. Okay, it was like Russian mob rate money. It's become a lot better since then because the Build for Rent community is a lot more well known. The asset class is more established, but it really, the kind of financing that you're going to get depends on what you're going to do. So we want to talk through that a little bit today and give everybody a little taste for it. You can certainly contact us if you have any questions. We might know somebody that can help you if you have financing needs in the Build for Rent space. Let's start it off with its most basic. Go to the very beginning here. Maybe you're going to do an infill lot. You're going to build your own property, right? What kind of financing is in play here? What would you guys do?
You're going to go residential. You're probably going to have to do 20% down. Depends on if you're able to wrap your lot into it, which you should be able to. Sometimes it all depends. Sometimes they're going to want you to put 30% down and put a little more skin in the game, but you're going to go residential.
Well, and I would be on the unit count too. If it
depends on the building.
Yeah. Well, I was thinking you were meaning single family infill. So sorry.
And you're right.
That's some infill. There's some good opportunities, 1 to 3 acres that are bigger units, 30 or 5 plus units, I should say, that could be 30 or 100 units infill. Yeah.
Yeah. So the question is the land already approved? Right? Is it permitted? Is it approved for a certain kind of a building? So in that case, right, do you own the lot or do you not? Right? The lot counts as equity in the deal. So if a lender's only willing to go up to 70 cents on the dollar as to what they're going to loan you, and maybe you own the lot free and clear, you inherited it or something, that goes towards your equity, and you might be able to get a construction loan just for what's called your vertical costs. Right, actually building the building, right? How does it get different, though, when we're talking about land that is not approved? Maybe it's not subdivided or entitled. Well, how does the financing become different there? Any thoughts?
From my understanding, when you're getting a loan on a piece of dirt or some land, it's interest only. Terms aren't going to be as good. They're probably going to want to see a good chunk of money down, at least probably 30, maybe 35% down. So yeah, if you're buying a piece of property for $1 million, you're going to be into it at least 300,000, maybe a little bit more, interest only.
And I think some people are going to go the hard money route too.
Right. Because there's loans through banks where you fit a certain. There's a loose set of parameters, right? I know that if I can check these 5 boxes, a bank is probably going to give me a loan. But hard money is when banks don't want to give me a loan. That's why I'm willing to pay the astronomical interest rate that comes with hard money, right? And that's all a question of risk.
Or do I need to close pretty quick? So I'm going to use hard money to close, and then you can flip yourself out of it with a construction loan of some kind. But
Correct. So one of the terms we would want to go over then is it's called A&D money, acquisition and development money, or capital. And that's a specific kind of loan that banks definitely do, right? Well, if a builder needs money to buy land and develop it and get it all the way to permit, right? That's an A&D loan, and banks can do that. But if you're new and you're going to go in and say, I need A&D money, I need $4 million for this 20-acre piece, you're not getting that loan. You typically have to have a relationship with that bank and a track record before they're willing to cough up some A&D money. And beyond then, you need to go hard money.
Or you might need to have some cash in the bank, or some assets, or cash.
yeah.
Yes.
in your bank account.
User
They
pledge.
want to see that. Yeah, they want that risk to go away and know that they're well collateralized.
Yeah.
You know, our good friend Lane Aldrich, who's our preferred lender for most of the multifamily that we do on the fourplex front, mentioned to me today, he invests money in a vertical construction fund, right? These guys set up a fund, and all they do is fund vertical loans. First position. What's first position?
They're the first ones to get paid off. So they're at the top of the line. You're going to usually you're going to have a second on it too, but they're the first person that gets paid off when monies come due.
It's the most secure position, right? You know that you're very likely to get all your capital back if the property gets sold or if there's a foreclosure or something like that. You secure that with a lien in states in the West where there are non-judicial foreclosure. Sorry. Had a little bit of a brain, there. So A&D money, these guys just do it for vertical. So private investors come to them and say, here's $300,000 from my IRA. And then the fund goes out and finds builders that have land that's ready to go and they need capital to go vertical with, right? So you could find a company like that specializes in vertical financing. Why do you think, because that vertical financing is going to be more expensive. Why would somebody go the more expensive route? Then why don't they just go down to First Bank of Arizona?
It's a good question.
Yeah. I mean, usually it's because they don't have the funds behind it to back it. I mean,
Well, so the terms at the bank are better, but the qualifications are much more stringent. Is that what you're saying?
Yeah, there's no way they're going to qualify. So if I know that, I could go get some hard money, because some of these hard money people are going to, or a fund, if you will, they're going to be more willing to loan to you knowing they're in first position because they can take over the piece of dirt or land, whatever you're trying to develop, right? Some of these banks, they're not in that market to go do that. They don't want to do that. But yeah, the qualifications are going to be a lot higher and more stringent.
Yeah, they're going to ask you a lot of stupid questions, go through all your paperwork. And I would add, though, that the hard money is going to still ask a lot of those questions.
Oh, 100%.
Yeah. Mm-hmm. But they can typically move a lot faster. A bank is going to, they can't go to the bathroom in less than 30 days, let alone do an A&D loan. So the first step listeners have to take in mind, is my land entitled, approved? Does it have permits? You might be able to just get a construction loan depending on how much money you're bringing to the deal. But are you subdividing? Are you actually developing dirt? You're going to need private capital or A&D capital. Like when we do our stuff for FIG, the Fourplex Investment Group, Aaron in our company has a whole bunch of individuals he goes to, and he created a fund that only loans money on a FIG deal, right? And the way that gets handled is they record a mortgage against the entire property. And then when our investors come in and start closing on fourplexes, that A&D capital gradually gets paid down until it's paid off. And that's a great way to minimize the capital that we have to have into the deal. But once again, a normal bank, that's not going to fly. They're going to want to see equity in the deal, right? Mm-hmm. So there's creative ways to do it. Okay, so that's A&D money. And, interest rates with a bank, 4-ish% as we record this, right? Hard money is going to be close to 10% with a couple of points on the front, right? A couple percentage of your loan amount. So, all right, we've got our land, it's developed, it's ready to build on. What about construction financing? What comments do you have there? Thoughts?
I think when people hear of a construction finance or construction loan, if they haven't been through it, they get a little bit nervous. It's a little bit foreign or unknown. But once you've been through the process and understand it, it's not as scary or intimidating. But typically is what you can plan on is a construction lender is going to want to see at least 25% down, and you're going to plan on some buying cost or closing cost. And so you need to understand, okay, what's in that buying cost, closing cost, just like with any other loan that we're talking about here, right? And so a lot of times in the buying cost, you're going to see a interest reserve account. You can either pay on that monthly a lot of times, or it could be paid up front. That's how we do it. We collect 12 months up front, and we have that held in an interest reserve account. So when you're getting a construction loan, it's interest only. Plan on paying the either monthly payment for that loan or up front. There's going to usually be a 1% origination fee, maybe more. You're going to see appraisal fee, closing costs, things like that.
Okay.
And then I think it also depends on, are you going to have to go commercial, or are you going to be able to do residential, right? Depending on the amount of doors. So we've done projects where anywhere from 1 to 4 doors, we can get you residential, and then 5 and above, you need to go commercial. Terms are usually not as favorable commercial, but they still do work.
Yeah.
And sometimes that process is a lot harder. But through commercial, you can also do it in the name of an LLC, where you go in residential, it has to be in your personal name.
That's right. Going residential, once again, this is a bank, and they have very set requirements. When we say going residential, we're talking about these conforming Fannie Mae loans. And there is a very specific set of criteria that you have to go through, and you either meet it or you do not. Very rarely is it blurry. One thing that happens to me a lot is when I send somebody to a commercial lender that's been used to dealing with residential, they always call me like 60 days later mad. Like, these commercial guys are clowns. I'm like, well, there's not a criteria, right? This is a bunch of old bankers that collect all your financials and get in a committee, eat some donuts, and talk about, do we like this guy? And black and white answers don't always come out of that meeting, right? So commercial is, there's like a thought that's expressed a lot. People say, I want to do commercial deal because they don't care about my credit score or my financials. They just care about the deal. Not true at all. But what is true, they care a lot more about the deal. On a residential loan, it is Chase's credit score and debt to income ratio purely that does that deal. On a commercial deal, it's, is Chase an idiot? Okay, he's not. Is he financially viable? Is he solvent? Great. Now, how does this deal look? Right? Because it doesn't matter how good you look if the deal doesn't look good. It has to stand on its own. Right? So there's a term, debt service coverage ratio. Right? Anyone want to take a stab at that?
I'm not going there.
She's not going there.
I'm not going
All right,
there.
well, I teed it
Basically,
up.
I know we wanted to be at 1.3 or 1.4%.
Usually 1.25.
Okay, yeah.
Yeah.
I know that just from doing a few of the deals, but I'm not as knowledgeable about it. So
Yeah,
we'll punt that to you.
You can look it up. It's just a way of saying, like, how much income do we have to cover the debt that's being incurred? And if that ratio falls below 1.25, lenders are going to just want more money down. Right? It's the equivalent of an appraisal not coming in high enough on a property. If the debt service coverage ratio is too low, they say, we're giving you too much debt for this business. That's what they consider it to be, as a business, right? And your business doesn't make enough for us to feel comfortable that you're going to cover the debt. So bring more money in. Instead of 30% down, bring 35, bring 40% down. I'm working on a deal right now with a foreign national that I'm partnering with to do 72 doors. And the bank kept saying, well, I don't know what the debt service coverage ratio is. Well, this guy's from overseas and is feeling lucky to borrow the money, and he'll bring as much as possible. So I said, you tell me, what does it need to be? We'll bring the amount of equity. Then when they say, oh, wow, you're the dream client, you're just going to put more down. I'm like, if that's what it takes. But then I looked at him and said, but I'm going to get you on the next one. Like, when we prove that we know what we're doing here, right? So debt service coverage ratio. What about the length of the construction loan on like a normal conventional loan versus a commercial, right? Are they typically longer, shorter? What's that like?
Commercials, yeah. Residential is going to be usually 12 months. You can get it longer. Commercial is usually going to start at 18 months total term. And again,
which
you can
we're getting them
extend
shorter, or
Yeah.
we're getting them longer now.
Yeah.
Because of delays. Yeah. Yeah. So the commercial loan has to be 18 months at least, because that commercial lender wants to be sure that once this property is done, the buyer has sufficient time to lease it, typically to 90%. Because once again, they're qualifying a business here. And you're not going to build a commercial property and lease it, of 50 units or more in 12 months. You're probably not doing it in 18 months, given how things are going right now. So most of these are creeping up on 24. It gives you time to build and lease and then refinance out of that commercial construction loan. So you said something about terms not being as favorable. What do you mean specifically?
I'm meaning more your long-term interest rate. Usually on commercial, it's anywhere from 1/4 to 0.5% more. Sometimes it can be even more than that, but it's usually a higher interest rate for your permanent financing, long-term financing.
What else? I can think of a few things. A higher interest rate, slightly amortization period.
Mm-hmm. Yep, you're going to go 25 years.
Yeah.
Some of them have been able to do 30 years,
Yeah.
but it's usually 25 years, and it's either a 7 or 10 year arm or something of that
Yeah.
nature.
Well, and if you're a big accomplished borrower with HUD might amortize over 40 years, right? With no balloon payment. So the typical commercial loan is, well, we're amortizing this over 25 years or whatever, but you got to pay it off in 10 years.
Yeah.
Right. But on some of these giant HUD deals, and they're tricky, but some guys are really good at them. I've personally never done one. 40 years, due in 40 years, right? That's crazy.
That's insane.
Yeah.
Yeah, got to get some of that capital going. So I think too, one thing that you got to keep in mind is when you have a commercial long-term loan, you're subject to audits by the bank, right? They underwrote that saying, oh yeah, you do meet the debt coverage ratio, but in a year, do you? They're going to want to know, right? So you got to have that dry powder in case you don't, because they're going to require more collateral for the loan. So the advantage on those fourplex loans, that really has been our bread and butter, is that 4 or 30-year fixed, true, right? Nobody's bothering you because it's only you qualifying for it. Nobody's asking you any questions, and it's an excellent inflation hedge.
Yeah. One thing that I like that we do is with Lane, we get everyone pre-approved ahead of time. So when you're going through our process, you're actually getting pre-approved for your long-term financing, which is a little bit harder to get approved for than the construction. So don't let the construction loan scare you off.
Yeah. Yeah.
Yeah. Just know that the construction loan, like we've talked about, it's more of a 12-month loan, interest only. The rate's going to be about a point higher than the 30-year fix
Usually,
conventional loan. So just know the rate's a little bit higher. You don't want to be in that loan forever. You want to be in 12 months or it's as short as you can whenever the construction's done. And then when it's done, it's just a simple refinance into that 30-year fixed conventional loan.
Yeah, the rate's a point higher. That's assuming, though, that you're going with a bank.
Yeah.
If you're going with hard money, it's 3, 4, 5 points higher.
Yeah.
Right? It's a lot. And I would add, too, that when you get a construction loan through a bank, your terms are usually better if you prepay your interest reserve. If they know that's just sitting in their bank, right? They've got that. They can pull that out every month. That's worth something. I've seen it get a couple of loans across the finish line where they were marginal on it. Well, what if we prepay the interest? Oh, they perk up a lot.
Yeah,
Definitely.
They like that. They have that money sitting there.
Yes, absolutely. Well, we've just about got to run here. Any other comments on financing? Because we're going to bring Lane on. We'll bring some commercial people on.
Yeah.
Financing is a tool, right? Use it. I'm a big fan of the real estate guys, Russell Gray and Robert Helms. They say do the math, and the math will tell you what to do. And the good thing on loans is that it's pretty straightforward. You know what you're getting.
Yeah, there's a lot of options, and explore them. See what works best for you.
But there is a difference between good financing and bad financing. So just understand the difference between the two. Understand what you're getting into. Understand what the numbers look like from a cap rate, cash flow perspective when it's all said and done.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.